You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the aforementioned network. And if I sound a little bit different, if you hear some fun noises in the background, maybe some elevators, maybe some airplanes, it's because we're not in our studio in Chicago. No, we're down in sunny Florida for the Options Industry Conference. We're kind of live in our roaming studio, if you will. We got a lot of great guests lined up for you. And next up on the docket, we have a newcomer to the program and indeed to the network. He is Ivan Brown, the head of options over there at NYSE. Ivan, welcome to the Options Insider Radio program.
Thank you very much, Mark. Happy to be here.
And Ivan, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background and how you found your way to becoming the head of options at NYSE?
Sure. How far do you want me to go back?
Let's go diapers, I think is good.
So I grew up in a family where everyone was a small business owner. So very early on, I was accustomed to always wanting to go to a meeting and seeing what was up in the business, and from a very early age was always fascinated just by business in general and commerce. And so I knew that that's what I wanted to study when I ended up going to college. And so with that focus in mind, I pointed myself towards NYU, where I went to the Stern School of Business for undergrad, and focused a lot on management and organizational behavior, but also had a deep appreciation for corporate finance. And so all the things that go along with that, understanding weighted cost of capital and all of these sort of nerdy topics, but ones that are important to understanding the heartbeat and lifeblood of a company and how it works. And so that kind of morphed into sort of a broader interest in finance and the markets. And so at the time, as being kind of in the heart and center of New York City, obviously exposure to the financial markets was something that was readily available. And so at that time, as I was graduating, the New York Stock Exchange was just starting their first year of a business analyst program, so equivalent to a lot of the other analyst programs that you would see at some of the banks and such. And so for me, it was an interesting opportunity because, whether in other areas of finance or in school, you learn how things are valued and how they're constructed, but not necessarily how they're traded. And so going to the exchange space provided you a pretty unique view into sort of the inner workings of market structure. And so started there. I was actually on the listings team for 2 years, working in sort of a strategy and business development capacity. And then after finishing the program, got introduced to a gentleman named Ed Boyle and Steve Crutchfield.
I have no idea who those people are.
Yeah, probably not too familiar with many people in the industry.
I was just in that chair a couple hours ago. So.
Exactly, and so it's a small world. It's a small world. So anyway, they were looking for someone to come onto the options team to think a lot more about pricing and strategy, and over time I built a team on NYSE where I was head of strategy and was thinking about all of our market structure, strategy, pricing strategy, things about partnership and joint venture and things of that nature, and eventually morphed into assuming responsibility for the options business 3 years ago in April.
Well, great. So, it sounds like it's been an interesting journey for you. Interesting timing to kind of take over the options business there. Obviously, we're coming on the heels of a pretty hot year from an options perspective. Record volume across the board, the return of volatility, welcome and perhaps unwelcome, depending on which part of the space you find yourselves. Walk us through some of the highlights from. It's been a while since we've had an NYSE person on the show, quite frankly. So walk us through some of the highlights from an options perspective over there at NYSE over the past year.
Yeah, I mean, just to speak to the last year, I mean, I think, if you look at multi-list equity option volume, 18 versus 17, we were up 24% as the industry. Compare that to like 12% in the equities market. So obviously it was a banner year for options, as you spoke to. From an NYSE's point of perspective, we were up 42% over the same time period in terms of volume. So we're really happy with that. We've seen growth 7 out of the last 8 quarters, which has been really great. And so, when I was looking at the business back in 2016, one of the main things that I wanted to do is have a pretty concrete commitment in terms of building out our performance, our functionality, and our product over a course of like the next two-year time horizon. And so that started off with completely replatforming our existing markets on all brand new trading hardware. And then that went stem to stern with gateways and the rest of it, really focused on increasing the performance and determinism of the market. And I think relative to what 2017 numbers are, we've seen roughly a 50% reduction in our averages and a 40% reduction in our tails. So we've really tightened up the performance story, which has given us a really good foundation to continue to build on with a good robust feature set. And so, over the course of the last couple of years, it's been very feature-focused. Things like complex price improvement auctions and step-up functionality and repricing, et cetera, all of which thematically is aimed at giving our clients greater control and flexibility over what their execution experience is on our markets. And so as we've invested in our markets, so too have our clients, and that's reflected in our results. So, I think that's been, quite good for us. More recently, it was very exciting. In March, we cut the ribbon on NYSE West. And so as many of you, know, our Arca Options business has been around since effectively the inception of options trading back in the 70s. And so we've owned and operated the Arca Options trading floor in San Francisco since 1976. And it's been in downtown San Francisco since that time. And we recently moved it to its new home, NYSE West. So it's a new state-of-the-art facility. It gave us the chance to take a look at what are all the modern demands in a 2019 environment for an open outcry trading space, and be able to provide that to our trading community. So it was an important moment for us to be able to demonstrate our commitment to that business, which is very important to us. And as an aside, it's also a great space for our listed companies to leverage, since we have 300 plus listed companies and prospects on the West Coast. And so I don't know if you've been to our Love and Wall facility in the last couple of years, but
it's been a while.
Yeah, so we completely got renovated that entire building, and so the 6th and 7th floors are a completely modern open space for our listed companies to leverage for analyst days and board meetings and things of that nature. So it's a very important point of congregation, and we want to be able to provide that on the West Coast too. So it's been a busy couple of years.
It is interesting, how we've seen a lot of that in the space of late, a lot of rebranding and, if you will, repurposing of old trading floors to kind of accommodate, like you mentioned, the new needs of the space. We've seen, of course, the NASDAQ doing that with the old Philly, moving it and kind of rechristening it and giving it a new focus. Ed Boyle was just in here with Box talking about what they're looking at for their trading floor that they launched. And now, of course, the old PCOAST, now NYSE West. So give us a little bit of a visual of what the NYSE version of this looks like in 2019. Obviously the old PCOAST floor was a trading floor. It had all the kind of the crowds and everything like that. Obviously in the modern era, I'm assuming those are smaller. And you mentioned some of the meeting space. Give us a little bit of a visual of what the PCOAST, aka NYSE West, looks like now.
Yeah, I think it might be good just to contrast a little bit for what the historic space was. It was certainly near and dear to our heart, given the fact that it was our home for 35 years. But, it was not a remarkably exciting space, very limited, window and a little bit darker and such. And so, it was not reflective of what sort of the right profile from a San Francisco real estate, made sense. And so in the new space, it's really about openness and light and ensuring open workflow. And so I think, when you walk into the space, you can think of sort of the floor, the building, as a large donut, right, where the elevators and the welcome areas in the central part, where the sort of listing and corporate functions are on one side of the floor and the trading floor is on the other. And so it's broken out across 3 different trading crowds in big sort of semicircular function where there is, regulatory officials in each pit stationed with a big sort of arcing window at the end where natural sunlight can kind of stream all the way through, which is probably a welcome change for where you come from a darker environment.
That's definitely a change.
Yeah, so we've been really happy with it. From my perspective, it's amazing when you sort of end trading on a Friday, you move over a weekend, you start trading cleanly on Monday morning, and all of the effort that goes into making that go correctly, right? And so it's a testament to all the teams across NYSE, whether technology or networking or engineering and facilities and such, to really make that right. And so they did a fantastic job. And when the largest complaints are where the water bubbler is located, that generally things are going well.
I guess things are going well because traders are not known to be reticent to register complaints. So if they're not complaining, I guess you're doing something right. Well, we're talking about trading floors, and it's kind of interesting because you guys over there, obviously NYSE and indeed at AMEX, still maintain one of the more vibrant open outcry communities in the options space, which I think, given all this we're talking about technology, may come as a surprise to a lot of people, but there still is a lot of demand for that high-touch, complex, open outcry type of execution. What kind of order flow are you seeing going through to those types of venues now at NYSE, and are you seeing still a strong demand for that here in 2019? Yeah,
I think it's kind of interesting, the sort of circular evolution and how that plays into sort of market structure. From our perspective, we operate 2 of the 5 of the industry's trading floors, and they're certainly a very robust and important part of our business. And, when we think about our market models generally, both across the options and equity space, we operate a number of different models to provide different choice and execution opportunities for our clients, right? And so open outcry is sort of an extension of that. And so where the floors are, and as you know from your experience, where the floors are particularly well suited is for dealing with large institutional sized orders or ones that are inherently more complex that benefit from the sort of intersection of a human judgment and technology. And so, we have that obviously in the equity space with our DMM model and the advantages that human judgment provide, and we believe that's also true in the options space. And so, in a world where you have 16 different venues for execution opportunity, oftentimes that can become a challenging thing when working in institutional-sized order, and that's where the floors are particularly well suited. Yeah, it has been fascinating. You're right. It is very cyclical. I think old is new again. For a while there was all upstairs, the death of open outcry. Then into 2017 and 2018, trading floors were hot again. We saw people rebranding and rechristening and relaunching exchanges, or trading floors, I should say. So everything old is new again. Yeah, in fairness, the floors have been a remarkably stable part of our business for time in memoriam, which is great. And I think, it's nice to continue to find opportunities to invest in them and keep them contemporary. Yes, that is a challenge when you have the old school open outcry against all of the new technology that we were just talking about earlier. Speaking of old school versus new school, we are seeing continued proliferation on, shall we say, the new school side. We're up to, I believe, 16 exchanges now, MIAX adding their 3rd venue. I'm curious, this is the first time you and I have had a chance to chat here. This is a frequent topic of conversation at a conference like this. What are your thoughts on the continued proliferation of venues out there? And is NYSE perhaps thinking about throwing yet another hat into the arena there? Yeah, so I guess that's always the perennial question, right? Is what is the right number? I am legally obligated to ask that question at this conference. Well, consider yourself you've satisfied your obligation. I think NYSE has a somewhat unique perspective on this since, we operate two market models, but they're both major market models of scale. And as you know, we have 5 SROs, but 3 are dormant. And, from our point of view, we do have generally a concern about over-fragmentation of the marketplace and sort of the both implicit and explicit costs that creates to the industry. And I think since 2010, we've had 9 exchange launches, if I'm recalling correctly, or something in that vicinity. And, several of them have gained, critical mass, but largely a lot of them have not. And most of the time, I think that they're not particularly differentiated in terms of sort of market model and things of that nature. And so, it brings up an interesting question along the lines of, typically in most environments, market forces, dictate what is a good idea versus not a good idea. And so, but there's an interesting intersection here where both through sort of order protection and protected quote and things of that nature, the market can't necessarily vote as directly in terms of support based upon the requirement to connect. And so, from our point of view, that creates somewhat of a distortion, and I think, we would be open to a dialogue that tries to strike the right balance between continuing to encourage competition, which is generally good for the marketplace. It forces, folks to innovate and up their game, which is absolutely necessary and good for the market, but also seeks to right-size sort of the value add versus cost to the industry of excessive fragmentation. And so, we spend a lot of time talking to our clients about the things that are important to them, whether it's market structure advocacy or new features or functionality or types of what have you. And, from time to time we evaluate, does it make sense, to look at a third market? And most of the time, up until this point, actually, we've arrived at no, because, if we were to do something, we would want it to be something that solves an unmet need or an underserved, marketplace. And up until this point, we haven't seen something that addresses that criteria.
So you don't feel disadvantaged yet by not having a particular model, because you're right. They call these exchanges, but they're really just attempts to target a new fee structure, effectively, right? And a new, or maybe a new technology in that perspective. So maybe exchange is a charitable description for them. But you don't feel that NYSE has any sort of competitive disadvantage by not being able to participate in the varied and many different types of fee structures that are out there by launching a new venue.
I think we're very happy with, as I said, we operate 2 markets at scale, and we're very happy with the performance of those 2 markets, and feedback from our customers has been the same. We remain obviously open-minded to the extent that we can provide, value by potentially creating something that's unique or different. That's an interesting conversation to have. It's just we haven't necessarily found the addressable market, and our customers aren't asking for us to solve that quite yet. So, I think we remain open-minded, but we're very comfortable with our competitive positioning.
Do you think, have you heard any positive feedback? You mentioned earlier about maybe trying to find some sort of middle ground where there is a competitive balance, but also maybe dialing back some of the excessive, maybe, shall we see, proliferation of venues you've seen of late. Have you seen any maybe uptake on that from the regulators? Are they charitable, that sort of idea, or is there any sort of movement on that front?
Not to this point. I think that that's a larger discussion. As I said, we remain very open-minded to participate in that dialogue. I think that, as I said, given our lens operating 2 markets, our view might be a little bit different, right? But certainly would welcome constructive, conversation and being a part of that dialogue. But fragmentation isn't just a function of venues; it's also a function of product, right? And so when you think about the tradable instruments that are available, and you're looking at about 1 million strikes. There's an opportunity where the industry is working and talking. Well, what are ways that we can right size and think about strike programs and things of that nature to sort of better reflect what today's market structure demands. That
does seem to be a hot topic. We've talked about that a lot here with our guests already here, and I'm glad to see there has been some movement on that front, because we're talking about exchanges and proliferation of trading venues. The other side of that coin, of course, is the burden that places on everyone out there, the participants, the customers, of course, the market makers out there. The liquidity provider community in particular, a very highly taxed, highly burdened audience. There are obviously much fewer of them now than there were 5 or 10 years ago. So the industry is obviously motivated to maybe do something to try to lessen that burden. Do you think mitigating the strikes is perhaps the best first step we could take in that? And maybe, do you have any other ideas for how we should proceed along that front to really try to lessen the burden on the market makers out there and get them out there quoting tighter and more aggressively?
Yeah, I mean, a couple of things. One, I think that the opportunity to, sort of review things like strike programs is a good area to potentially consider. That having been said, it would be a mistake also not to recognize, by the way, last year, that in the record environment in terms of volume and volatility, the options markets performed remarkably well. And that's not just a testament to, NYSE and my colleagues, but also my fellow exchanges and all of our trading clients who all collectively handled that experience very well. And that's because we all plan and test and ensure that whatever crazy day there is, we're able to handle it. And that ultimately inspires investor confidence, which inspires investor participation. And so it was important to recognize the fact that, when liquidity was asked for, liquidity was provided. And so it's helpful to sort of keep a relative context for these types of things where there are a lot of things that, are positive influences coming off of that, and it's important to recognize. The other thing, that I would note is that, we at NYSE did a study recently to take a look at the influence of recent volatility on displayed markets. And it wasn't a study that was intended to look at like historical evolution over a long period of time, but it was an impressive volatility cycle, particularly in Q1 and Q4. And how did the options markets hold up? And so what we ended up doing is converting spreads as a percentage of the price, and looked at displayed size on a notional basis. And effectively what we saw is that as the option market volatility increased, that went in tandem with price, and so on a percentage basis, option spread stayed remarkably stable even in the most volatile time periods. Exception to that was back in Q1 where volatility spiked, like the VIX went up like 20 points in 2 days.
A bit of an aberrant scenario there.
Yeah, but I think all of those things are important to keep in mind that, the markets are functioning quite well.
Speaking, you mentioned products, and you guys have some of your own new products in that fray. Excuse me. All this dry Florida air drying us out here.
Yeah, I know, we're doing the same thing.
All this talking dries you out quite a bit. But you mentioned you have some new products of your own out there, getting into the FANG realm, the FANG Plus Index options and futures. Give our listeners a little bit of an overview of those and how they've been faring so far.
Yeah, so the FANG Plus Index is effectively an equal weighted index consisting of 10 of the top next generation technology or tech-enabled consumer discretionary companies. So the normal FANG stocks that you would think of, plus others like Baidu and Alibaba. And so we created that index and launched a future on it back in November of 17, and then launched a cash-settled European-style index option in June of 18. And so, we're excited about that, obviously, from the perspective of it gives investors another way to participate and, if they want to seek exposure to that or hedge exposure, and they can use that through either a future or an option vehicle. And so it's been interesting. We obviously think that the equal weighting addresses some of the sort of market cap, kind of distortions that you get in a more traditional market cap weighted index. And so that's been interesting. Obviously, there's been a lot of movement in the FANG series of stocks, particularly in Q4, and now we see a resurgence in Q1. So it's an interesting time period. From our perspective with new products, it's naturally always a slow but continuing process, right? And so, we're working with our liquidity providers to make sure we have the right support in place. We've had a diverse, range of participants interact with the product, which is encouraging, and we're slowly but steadily building open interest.
There's always that challenge with the new product, right? There's the catch-22 of people don't want to commit to it until, whether they're a market maker or a customer, until they see volume. But of course, how is there going to be any volume or tight spreads until they're actually committed to it? So it's a delicate dance. I don't envy you guys in the early days of launching a new product as walking that tightrope.
No, intimately aware of that. But, slow and steady progress is good, but the most important thing is patience.
Well, this is your first time on. I like to take the pulse of our guests at this conference on a variety of different issues. One that keeps popping up year after year. I'd be curious to get your thoughts on it as well. And one that's near and dear to the hearts of our audience. Whenever I ask them when I'm coming down to this conference and I ask them, what would you like us to talk about? This one always pops up, particularly this time of year during earnings season. This is, of course, the topic of after-hours options trading. People out there see that they could trade their stock on, Google or an Amazon, whatever it is, and open or close those positions in the after hours if they want to, particularly during earnings. And yet they can't do the same thing on their Google or their Apple or their Amazon options. So I'm curious, what are your thoughts on the prospect in general? Are you pro? Are you con it? Do you have a view on the notion itself? And then B, how far away do you think we are from actually adopting that as an industry?
I think that is an area where we have not spent a tremendous amount of time or focus. Certainly, the use case can be understood, right? Obviously, with some of the movement in some of these stocks, particularly around earnings. That having been said, I think what is important, if you were to consider those types of things, is making sure that you have meaningful liquidity provision at the right time to ensure that the experience for the end user is a positive one. And so, again, getting into what that requires. In terms of ensuring, again, you're thinking about sort of the fragmentation point of view and things of that nature. You kind of look at it from that perspective, and you still have to balance that out, right? And so it's not necessarily something that would probably be appropriate for necessarily all securities. And so I think it would require a fairly measured approach. But it's not necessarily something, obviously, in some respects we deal with different audiences just in terms of degrees of separation. It's not necessarily something that our clients have been sort of directly focused on, I would say. Although you do see some instances of retail firms and things of that nature thinking about that space.
It definitely seems bifurcated where the retail-focused firms and the retail-focused audiences, they want it. They want it, and they want it right now. And then you're right, on the institutional side, they have to staff up, they have to deal with the issues of liquidity. On the exchange side, same question. So they're a little bit more reticent. So you definitely have one side of the space that is just champing at the bit. They can't wait to get at it. And then the other side that's a little bit more hesitant, shall we say.
Yeah, I think at the end of the day, it's important to have the right infrastructure in place to ensure that the experience is positive, right? Just like when we trade in any other part of the day, that's an important component of the ecosystem, which just needs whatever it is, measure twice, cut once, measure 3 times, cut once, type of approach.
Well, Ivan, I'm glad we can get you on the show here for your first time. And before we go, we like to give our guests a chance to maybe leave our audience with a little bit of a hint, a little bit of a tease of what they can expect from you guys coming down the pike in the coming months. Maybe you have a big announcement you're planning here at OIC. Either way, sir, now is the time. The floor is yours.
Oh, well, thank you, Mark. Listen, first of all, thank you again for having me on the program. It's been really enjoyable to have a chance to sit down and talk for the last few minutes. From our perspective, 2018 was an exciting year. We hope to obviously continue the momentum going into 2019, obviously coming off the heels of the NYSE West launch and such. We obviously have been up to a lot. I think, from the second half of the year here, you'll see, probably quite a bit from us as we're focused on the sort of performance space. So a lot of things continue under the hood, continuing to drive additional latency reduction and improvements in that space. And, certainly, something that you're probably aware of, but one of the big projects that we're working on just at NYSE more broadly is our new trading system. And so that's called NYSE Pillar. We now are operating the majority of our equities markets on NYSE Pillar, and we are going to be moving over Tape A on NYSE later on in the year. And so as that unfolds, we'll be looking to transition our options markets to that, in the following year. And so we are going to be knee-deep in the requirements gathering and discussions across the board with our clients and constituents to make sure that as we go and build out this new system that we're thinking about things the right way. And so it'll be a busy year ahead with sleeves rolled and elbows deep. But the other side of it is, we continue to look forward to being a market steward and forwarding on some of the market advocacy point of view, whether that's, working with the STA listed options committee or the new options market structure working group, and hoping to advance some of the potential market structure reforms that are helpful for the industry. So.
Well, Ivan, I'm glad we can get you on. I'll look forward to seeing how all these new initiatives unfold in the marketplace in the coming months.
Oh, thanks, Mark. Thanks for having me.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.